Welcome to Finance for World. Today, we are mapping out the massive chain reaction that's currently shaking the global economy. In this explainer, we're going to track a really fascinating and honestly quite complex sequence of events. We're starting all the way over with Middle Eastern geopolitics and tracking it straight down to your everyday wallet. It's a classic domino effect, and visualizing how all these pieces connect is absolutely crucial for understanding our current financial landscape. Okay, let's run through our agenda for today. We're looking at 5 key areas. First, the global oil shock. Second, central banks under pressure. Third, treasuries hitting 2007 levels. Fourth, the crypto market fallout. And finally, the squeezed retail consumer. So let's jump right into section 1, the global oil shock. This is the geopolitical spark that sets everything else in motion. Now, what's really interesting here is this baseline number. Crude oil hovering right around $104 a barrel is essentially the pressure cooker for the entire global economy right now. Brent crude has been highly volatile. It's cooled just slightly to hit this level, but it remains incredibly sensitive to any news coming out of the Middle East. And, when energy costs are sitting this high, it bakes this massive underlying pressure right into the cost of producing and transporting, virtually everything. And here is exactly why that price is bouncing around so much. We're watching some highly delicate negotiations unfold. And right now, there is basically a 50-50 chance of an agreement over the Strait of Hormuz. On one hand, US Secretary of State Marco Rubio has noted some good signs, but simultaneously, US President Donald Trump is preparing military strikes if talks fail by the end of the week. And Iran is actively threatening retaliation if the ceasefire is called off. So we're just impartially watching this extreme uncertainty. This is exactly what's keeping the energy markets, our very first domino, so precariously balanced. Which brings us to section 2, central banks under pressure. This is where that first domino smashes into the second. Skyrocketing energy costs are forcing central banks into a seriously tight corner, building a stark contrast between the major players. Over in the US, you've got a divided Federal Reserve holding rates between 3.5% and 3.75%, and they are actively pivoting away from rate cuts as their incoming chair, Kevin Warsh, takes the helm. Meanwhile, across the pond, the European Central Bank and Christine Lagarde are desperately trying to keep their long-term inflation expectations anchored at that magical 2% target, despite the energy shock. They're both struggling with the same problem, but their internal dynamics couldn't be more different. So, about the new Fed chair, Kevin Warsh. His playbook might completely change how we look at things. He has a strong preference for something called trimmed mean inflation, which is currently sitting at 2.3%. Basically, this metric strips out the most extreme, crazy price changes to give us a clearer picture of the underlying trends. What does this mean for us? Well, it means Warsh might interpret inflation pressures and the whole timeline for rate cuts very differently than his predecessor did. And if we peek inside the April Fed minutes, wow, it was one of the most divisive meetings in decades. You had 3 FOMC members explicitly voting against language that even suggested an easing bias. Because of that persistent energy shock we just talked about, officials are realizing they might have to keep borrowing costs elevated for much, much longer than anyone thought. In fact, markets are completely reversing their bets right now. They're actually pricing in a potential rate hike in early 2027. The whole idea of imminent rate cuts, that's completely vanished. Let's move on to section 3, treasuries hit 2007 levels. This sudden realization of higher for longer rates aggressively knocks over our third domino. We are witnessing an absolutely staggering shift in the US Treasury market. The 10-year yield is surging to 4.687%, and look at the 30-year yield, hitting 5.2%. Long-term government borrowing costs are now at their highest levels since 2007. This isn't just a blip, it's a massive repricing of risk across the entire global financial system. How did we get here? It's literally a step-by-step chain reaction. Step 1, persistent energy-driven inflation. Step 2, that inflation eats away at the safe haven premium of US bonds. Step 3, massive legislative spending. For instance, the Obey Big Beautiful Bill is projected to add an estimated $2.8 trillion to the deficit over the next decade. And finally, step 4, the credit agencies react. Moody's downgraded the U.S. credit rating to AA1. So to actually attract buyers amidst all these fiscal risks, the government simply has to offer higher yields. And the market doesn't think this is over. This is a staggering statistic from a recent Bank of America survey. 62% of global portfolio managers expect that 30-year Treasury yields to eventually hit 6%. The bond vigilantes are well and truly back, and they're demanding fiscal discipline. When almost two-thirds of the pros expect yields to climb that high, it's a huge warning sign. Now for Section 4, the crypto market fallout. Let's see what happens when these massive macro forces crash into speculative assets. The velocity of this fallout is just breathtaking, $159 million. That number represents a massive wave of global cryptocurrency liquidations that happened in just a single 24-hour window. As yields spiked, risk appetite completely vanished. And the traders caught most off guard? The optimists. If you look at the breakdown, traders betting on price increases, the long positions, took the absolute brunt of the damage, making up nearly $100 million of those liquidations. Think about it. When government bonds are offering you over 5% virtually risk-free, speculative capital drains out of places like crypto at lightning speed. This brings us to a really harsh reality for the 72,000 individual traders who were liquidated globally during this brief window. As this quote perfectly captures, when capital gets expensive and macro chaos ensues, the market ruthlessly punishes leverage. It is a stark, brutal reminder of how high interest rates expose financial fragility. Finally, we reach Section 5, the squeezed retail consumer. This is our last domino. You. This negative 1.3% is the sudden and sharp drop in retail sales volumes across Great Britain just in the month of April. It's a direct, undeniable reflection of wallets snapping shut. The macro environment is finally starting to bite down hard on Main Street. And to put that into real-world perspective, this brings us full circle right back to our very first domino. Auto fuel sales plummeted by a massive 10.2%. Because of those global oil shocks, motorists are quite literally driving less. They're making fewer journeys and actively delaying filling up their gas tanks just to save a few bucks. That abstract geopolitical spark in the Middle East has become a very tangible, everyday consumer burden. And this squeeze is incredibly broad. Surging bond yields mean 30-year fixed mortgages have shot up to between 6.34% and 6.54%, absolutely crushing housing affordability for new buyers. We're also seeing UK clothing sales fall by 2.4% as people get way more price sensitive, and online retail volumes dropping 2.3% in a single month. From struggling to secure a home loan to just skipping out on a new shirt online, the higher cost of living and the higher cost of money is actively suppressing everyday spending. So throughout this explainer, we've tracked these dominoes falling in real time. We went from a fragile geopolitical spark in the Middle East, driving up oil, to cornered central banks pivoting their stances, to bond yields soaring back to 2007 levels. That wiped out speculative crypto leverage, and finally, it's all squeezing the retail consumer's wallet. Which leaves us with this crucial, maybe even slightly uncomfortable question to end on. As you look at your own portfolio, your business, and your daily expenses today, you really have to ask yourself, is the era of cheap borrowing over for good? And honestly, more importantly, how are you preparing for a world where money simply costs more? Thanks for joining me for this explainer, and seriously, keep your eyes on those yields.